Hi, everyone. As mentioned, my name is Peter. I run the insights team at Carta. And for the next 15 minutes, we're going to be dancing through a whole lot of data about what's happening to venture capital-backed startups, where they've been, the challenges they faced in 2024, and then hopefully some optimism for the year ahead. We have to start these talks with a tiny legal disclaimer from my legal team where they would get annoyed with me. So I'm sure you've all read that already. We can skip past that. And if you'd like to get this information, I'm happy to share it with you. Just shoot me an email, peter.walker@carta.com. So let's take a moment and explore where this data comes from so it's useful for you to understand the provenance. At the moment, Carta aggregates and anonymizes data from 45,000 cap tables across the world, primarily in the US, but we have many, many startups in the UK, in Singapore, and Canada, and other regions. There's data from across the types of fundraising that you might be familiar with, from your standard seed and Series A rounds done on priced equity, all the way to safes and convertible notes, and the earliest ways that founders are finding to get money into their businesses. And unless I mention otherwise, you can take most of this data as coming primarily, again, from those US companies. Okay, we're going to start with perhaps a little bit of scary times. The market thus far, what's happened to venture capital in the last, call it 5 years, 6 years or so? Well, the first thing you have to understand about VC is that it's undergone a profound change over the last 6 or 7 years. And one of these years, particularly 2021, was an incredibly different year. We just went a little bit bonkers when it came to the actual level of investment, both in the US and abroad, into venture-backed startups. We've really never seen a year like it. And you can see that in 2019, 2020, and then again in 23 and 24, we had something around $20 billion or so invested into Carta cap tables every quarter. In 2021, that was more like 50 or even $70 billion. So when we talk about the funding dearth or a decline or sluggishness in fundraising, we're comparing it against this very, very high peak that just really was reality for only a single year. And if you look across the stages from the earliest stage companies at seed rounds to the late stage companies that we hope are about to IPO in Series D and beyond, you can see that the later the company was in its life cycle, the harder it was hit by this downturn in fundraising. So if you were about to IPO and you needed to raise just one more round before you got to the public market, this downturn was more difficult for you than if you were at a seed stage company and you had just begun your fundraising journey. But nobody escaped unscathed. And for the founders in the audience, one of the clearest signals that this should give you is that if fundraising has declined and the pace of rounds has slowed, then the time between those rounds that you should expect to take has to be lengthened. It used to be that here in the States, a lot of venture capitalists would suggest that founders would be raising every 18 to 24 months. We think that's a little out of date, and they should consider raising every 24 or 30 months and having enough cash on hand to make sure that you can make it to the next round. So as always, you need to spend those dollars very carefully. There's still a lot of activity happening around venture capital, but some of it is going into bridge rounds versus primaries, which is important because a bridge round is often led by people who are already investors in the company, and they're merely giving that founder a little bit more cash in order to get them to the next round. But it's not a true jump in fundraising. And that is just taking up a lot of time and attention that used to go to net new investments for these VCs. Of course, this chart is maybe a little bit difficult to read at a glance. So if we just focus in on this section here, what this chart is telling us is it gives a sense of how quickly companies graduate from seed to Series A, which is a major choke point in the early stage funding of a company. Usually in the boom times back in 2020 or 2021, you would see that about 40% of companies made it from seed to Series A in less than 2 years. That's that 8 quarters on the x-axis. But in recent times, that's fallen all the way to 15%. So the drop from 38 to 15 is a gigantic drop in the number of companies that are actually able to raise that next round of funding in 2 years. So there's a lot of seed stage companies out there who are swimming around trying to find their next piece of capital. Of course, it's not always possible to raise that up round that everybody dreams about, that expansion of valuation. Sometimes you end up having, as a founder, to take a down round or a valuation that's lower than the one that was applied to your company most recently. That's nobody's idea of a fun time, but at least you're still in business. And all of this together just means that companies are staying private a whole lot longer than they used to. We used to see companies IPO into public markets around 8 years, maybe 9 years. Now the average on Carta is actually a dozen years, and it might even go higher than that. So if you're planning as a founder to have a 5 year journey with this company, I'm here to tell you, you should probably make it more like a decade that you'll be committed to building this business, even if you make it all the way to an IPO. And of course, those IPOs have gotten pretty thin on the ground, unfortunately, over the last, call it 2 or 3 years. We used to average something like 50 IPOs a year or so since 2010. We had a boom in IPOs in 2021 for technology companies. And then in the US markets, at least, there's just been sluggish IPOs over the last, call it 24 or 36 months. I'm really hopeful that we see this turn around in 2025. Okay, so you may be wondering, why did I come here to depress all of you with all of this bad news? Isn't there something useful to say about the way that startups are being built? And I actually think, no matter what you see from the global fundraising data, that now is a wonderful time to be building a startup. And here's why. So, first and foremost, the part of the market that has held up by far the best out of any part of venture capital is the earliest stages, investments into pre-price rounds on safes or notes, those new instruments to get capital into your business. And what this means is that angel investors and the earliest VCs are still willing to bet on young founders who are trying to make a difference and trying to build something really big. It's cool to see this very, very early innovation capital still flowing to businesses. You can see that it actually is pretty close to peak here in 2024 after dipping a little bit in 2023. Next silver lining we have is seed stage valuations. So yes, there are fewer companies that are raising rounds today, but the companies that are raising rounds are doing so at very robust valuations, especially here in the States. You can see it's almost $15 million on a pre-money basis. That's a pretty expensive seed round. If you can imagine the seed round, the company is only about a year, maybe 2 years old at this point. That is a very, very healthy valuation. It suggests that founders and investors are coming to reasonable terms and there are clean deals happening for these founders. Again, at the Series A level, we're seeing exactly the same pattern. Fewer rounds happening, but the ones that are happening are doing so at quite expensive valuations relative to historical averages, meaning that investors, again, when they are excited, they're very excited about the businesses that they're seeing come across their desks. And you may think, well, maybe the valuations are good, but I'm sure these founders are having to give up more and more of their companies over time. Surely the investors are demanding more of their companies because of the downturn that we've seen in recent years. But actually, that's not true. Founders are selling just about as much of their companies as they used to in seed and Series A. So this tells me two things. One, there's a lot of VCs, no matter what you may hear about them, that are not predatory and are really wanting to be fantastic partners to founders. And two, there's been a shift towards a founder-friendly mentality by the best VCs that seems to have stuck even in this downturn. And that's wonderful to see. There's not a lot of predatory behavior happening, even though capital has been a little bit harder to find of late. So why is this happening? If there are fewer rounds happening, why are valuations and dilutions still so founder-friendly? Well, if you all thought that we were going to get through this talk without mentioning AI, I'm sorry to disappoint you, but it is the story across US tech startups and indeed tech startups across the world over the last 18 months. So let's dig into AI for a little bit. On this chart, you can see AI, ML is that big red bubble up there in the top right. VCs are very excited about certain companies, and many of those companies happen to be AI companies for sure. The y-axis on this chart indicates how much was raised in a Series A round, and the x-axis is simply the valuation of those companies. So you see that AI companies tend to raise bigger rounds, higher valuations, and they actually do it more quickly than many other companies right now. If there was a downturn from 21 to 24, then within that downturn, there has been an AI bubble that has kept things afloat for the last 18 months in a really interesting way. And no matter where you look across startups, there's an AI premium being applied to these businesses. So if you're an AI company, you're in that orange line. If you're anybody else, you're in that black line. And you can see that investors are just valuing these in different ways. AI companies are valued more highly than their non-AI counterparts at seed stage. There's a gap of about $6 million. And at Series A stage, where there's a gap of about $20 million. So you can see that across the board, especially with early stage startups, investors are very, very excited about the potential of AI to revolutionize what's been going on across startups and hopefully bring us out of that downturn in general. The other reason why I'm excited about next year is because of you, the founders. You have all taken some really serious action to make sure that your companies are ready for this next phase of growth. So one of the biggest things that we unfortunately had to live through as a sector was a lot of tech layoffs from, say, 23 to the beginning of this year. That's the black line in this chart, just the number of employees laid off from tech startups month over month. You can see that it peaked in early 2023, and thankfully it's gone down month after month with a little bit of blips here and there since that time. So I am pretty confident that 2025 will be a year where we don't see nearly the level of tech layoffs that we've been dealing with over the past couple of years. The other thing that you as founders have been doing is you've been building your businesses more quickly with fewer people. Whereas a company that raised a Series A round in 2020 may have had 20 full-time employees, a company that raises a Series A round in the States today has something like 16 full-time employees. And that might get down to 13 or even 12 full-time employees when we bring in data from next year. So businesses moving more quickly with fewer headcounts is definitely the name of the game right now. And the people that are getting hired, they're not leadership positions. It's not a lot of executives. It's the people doing the real work, the IC contributors to these startups. That's your mid-level engineers, the ones who really build and sell the product. Those are the people that are continuing to be hired, even in this period where hiring has gone down a little bit. And across the world, I think a lot of the stories, the wonderful pictures that we're starting to see in the States are going to be reflected in other ecosystems as well. So if we go ahead and look at what's going on in, say, Singapore for companies that use our Carta platform to manage their equity, you can see that a similar pattern emerges with a giant boom in startup funding in 2021 and then a decline in recent years. But our estimates say that we're going to be about even for this year. And looking ahead to 2025, I wouldn't be surprised for us to start climbing again in total fundraising. If we jump from Singapore over to the UK and Europe, you can see that there's also some decent stories to be told about round sizes maintaining their size in seed stage and even growing in Series A across the European landscape. So if you look at Asia, if you look at Europe, or if you look at the United States, my instinct is that 2025 is going to be a better year than 2024 was. So let's wrap this up with some optimism for next year. First and foremost, my guess is that venture funding is going to pop back. We're not going to be at 2021 crazy levels, but we are going to be seeing increased momentum for a lot of different startups across the board. Our estimates is that we're going to take in about $102 billion across fundraising from all Carta companies globally next year. And that'll be up from about 80 or 85 or so this annum. The second good story and the second optimistic prediction is that there are still a lot of companies that are managing to do M&A and sell themselves for good prices. We see almost nearly record levels of M&A happening in the last quarter. And I think 2025 is going to see a lot of startup transactions happen as well. And then we get into who are founding these companies and why that's so exciting. First and foremost, the younger founders in our pool are much more diverse than our older founders. And it's wonderful to see people who may not have had the opportunity to found companies in the past be able to get into the startup game and become founders themselves, especially in those younger categories. And I'll end with this chart, which I think is fantastic, about the share of women hiring and equity gradually improving across the years. So you can see that the percentage of employees on Carta that were women have increased at the individual contributor level, the manager level, and at the executive level. And we've seen a corresponding increase in their equity holdings as well, the value of their ownership in these companies. There's more work to be done here, but this is a wonderful trend that I think we can all be excited about heading into next year. I hope that some of this data was inspiring or hope maybe even spark some conversation for you moving forward as to what the future holds for venture capital in 2025. If you'd like to follow along with the data that we produce every week, feel free to scan this QR code here. And again, I hope to be in person next year to do this all with you once more, but I deeply appreciate the time. Thank you so much for listening.